Good morning, everyone, and welcome to the JRG Advisors webinar for February. Our topic today is cafeteria plans. Which menu is right for you? Before we start the webinar, let's go over a little bit of housekeeping rules. You'll be sent copies of the PowerPoint along with a replay and also with answers to any questions that you may have within several days after today's webinar. Also, if you do have questions, remember that you can go ahead and type them in the questions box. And again, we'll address questions at the end of the webinar. So we'd like to go ahead and thank all of our valued partners who are participating today and who we do have the relationships with. They're mentioned here, and hopefully we have some members here on the line today. On our agenda, it looks like it's really a lot of information out there, and I'm not going to read the list to you, but these are all the issues that we're going to be addressing about cafeteria plans. You see, there is a lot of information here, so hopefully, you're taking this all into to heart as we discuss cafeteria plans. So let's really get started now. A cafeteria plan, it's not a typical benefit plan because it really doesn't actually provide any benefits, at least not in the way that we typically think about benefit plans. It's in and of itself a benefit. But again, it doesn't provide medical or dental or vision. Those are all our underlying group health plan benefits. What the cafeteria plan does is it serves as a type of funding vehicle for qualified benefits offered through the plan. It's a vehicle to provide employees the opportunity to make choices between a non-taxable benefit and cash while protecting them from paying tax on the cash that they actually don't receive. And that's a weird concept, and it's a weird tax concept. We're going to talk about that on the next slide. So what the cafeteria plan allows, it gives employees the opportunity to pay their share of the cost of benefits with pre-tax saving reductions. Remember, when you pre-tax the benefit for an employee, they don't pay the federal tax on it, they don't pay FICA tax on it. Likewise, the employer also saves money because they don't have to pay the FICA tax on those contributions. And this is, again, these are paying for the insurance premiums for medical, dental, vision, offered under separate welfare plans. So basically, in summary of this slide, a cafeteria plan permits employees to pay for benefits on a pre-tax basis. Technically, there is only one type of cafeteria plan, a plan that allows employees to choose between taxable and non-taxable benefits. However, in my years of experience, I've heard cafeteria plans referred to in many ways. And I think before we get into the different ways, let's just summarize it by saying, if it looks like a duck, quacks like a duck, walks like a duck, it's probably a duck. And it's the same with the cafeteria plan. So the different ways it's been referenced, I've heard it referred to as a POP, and generally that's just a type of plan that permits for the pre-tax of insurance premiums only. Some people will also call that a premium-only plan or even just a pre-tax plan. Also, we can have a plan that permits insurance premiums pre-tax, and then the employer also provides for a cash opt-out for those who may waive the health coverage. These types of plans are generally called a cash opt-out cafeteria plan. And then we have also plans that will include spending accounts, such as a health flexible spending account or a dependent care spending account, or even a way for employees to contribute to health savings accounts on a pre-tax basis. Another aspect where an employer will just go ahead and give dollars or credits for employees to spend on the benefits that they want, these are generally referred to as flexible credit plans or flexible benefit plans. And also, we've had a resurge of them in the last 2 or 3 years, and we call them defined contribution plans. So again, it's regardless of what you call the plan, if it performs the same function, pre-taxing benefits, it's generally a cafeteria plan. So we know that they're all subject to the Internal Revenue Code Section 125, and thus they have to meet those 125 requirements for the tax advantages to apply. And we're going to see that failure to go ahead and meet these requirements can result in taxable income to an employee. So the basic premise of the cafeteria plan choices is to give an employee the choice between non-taxable benefits and taxable benefits. The general concept of federal taxation is that all benefits received by an employee are taxable unless there is some exception provided under the Internal Revenue Code. And actually, the Internal Revenue Code has 3 different provisions that grants these exceptions. Just in a nutshell, there are sections 104, 105, and 106. And basically, they provide that when an employer gives benefits that will provide for accidental health, medical care, sickness, that those benefits are not taxable income to an employee. So, however, giving employee the choices between these benefits in cash or their regular pay can result in adverse tax consequences for employees who elect non-taxable benefits. And that concept is known as the doctrine of constructive receipt. It's really an archaic tax law, and basically what this tax law says is that if you're able to receive a non-taxable benefit and cash, that you should be taxed as if you did receive the cash. In other words, cash isn't going into your pocket, but you could have received it. So that's considered constructive receipt of something. And what the IRS tells us is that the only way that we can avoid this tax doctrine of constructive receipt is by establishing a valid cafeteria plan that meets the Section 125 requirements. And that is the exclusive safe harbor from constructive receipts. Where we'll see this come into play a lot is where employers will have a benefit plan. They say to the employees, you can do this on a pre-tax basis. So those are not taxable to the employee. And then they may have some employees who will come in and kind of like make a side deal. They say, geez, I don't want the benefits, so give me X amount of dollars. This is where employers will run into problem because of that doctrine of constructive receipt. And it could result in, again, taxable income to employees who do have pre-tax benefits. Let's talk a couple minutes about the plan requirements. Now, if you look up in the Internal Revenue Code under Section 125, it literally states it is a written plan. And it never really went into more detail than that. But the rule has always been that a plan document is required. Proposed regulations, and the last time we received any rules on 125 plans was back in 2007, spell out with specificity, though, what is required in the document. You have to describe the benefits, the period of coverage, eligibility, participation, election provisions, if the employer is going to make any type of contribution. So technically what it comes down to is no document equals no cafeteria plan equals no pre-tax benefits. The rules clearly provide the plan must be administered uniformly as to the terms of the plan. Again, a reason for you to have a plan document so you know what those terms are. Also, not operating according to the terms can result in what's called an operational failure, and an operational failure can result in a tax liability to an employer. And we're going to talk about operational failures in a couple of slides. So what can we offer? What kind of benefits can be offered on a pre-tax basis under a cafeteria plan? The statute and the regulations provide that only qualified benefits can be offered. And these benefits are specifically outlined. So they include certain benefits that are excluded from employees' income, such as medical, dental, vision insurance, HSA contributions, dependent care, adoption assistance, and group term life on an employee's life. So be careful with dependent lives and spouses coverage there. So these are the permitted taxable benefits. Again, they're called qualified benefits. And continuing talking about benefits, benefits that can't be offered are considered non-qualified. And that means that they can't be offered through a cafeteria plan even on a post-tax basis. And those benefits that are specifically outlined, again, in the statute and regulations are long-term care insurance and services, life insurance on the life of anyone other than an employee, scholarships, educational assistance, employer-provided meals and lodging, transportation programs, and then exchange-related coverage that may be provided for individuals. Now, we do have an exception for SHOP programs, and that's, again, beyond the scope of today's topic, but that is available out there. What I wanted to go ahead and briefly touch on is this transportation programs, transit passes, commuter transit, parking passes, and actually we can even have bicycle commuter that you can do pre-tax. A lot of employers will get confused with this because, again, you can pre-tax those benefits for employees also. However, they come under a different section of the Internal Revenue Code. They come under Section 132, which is considered a fringe benefit. So again, you can't put transportation parking or parking in a cafeteria plan. However, you can still do it on a pre-tax basis. It's just based on a different provision of the law. Also, as to benefits under a cafeteria plan, you can never offer a benefit that's going to be considered deferred compensation. Now, we all know what deferred comp is. It's something that you earn in one year, and then you go ahead and receive it in another year. Good example might be really a 401k. Could be considered deferred comp. But also, when we received those proposed rules back in 2007, they said there are some exceptions to this deferred comp rule. And probably one of the biggest exceptions we know is that if you have premium waivers under your plan, that would be deferred comp. You can go ahead and have a premium waiver situation under a cafeteria plan. Or if you have a contract for your dental or vision, that's for 2 years. It says this is also permissible to be done on a pre-tax basis. Another situation that's permitted is that if you take a salary reduction in the last month of the plan year to pay for the first month of benefits in the next year, that is an acceptable practice. What you have to be wary of, though, is that if you're taking a pre-tax contribution in the first day of a new plan year for a previous plan year, that is not permissible. So in the next slide, we're going to be continuing talking about benefits offered. And we know that a health flexible spending account, it's a component that can be done through a cafeteria plan. And the purpose of a health FSA is the salary reduction of an employee can make so it can be used for reimbursement of qualified medical expenses that are not reimbursed elsewhere. Now, expenses can be reimbursed for the employee, the spouse, and children under the age of 27. Generally, it used to be that you could only reimburse for a dependent that was a dependent under Section 152. However, when the Affordable Care Act was enacted in 2010, it amended the code that went ahead and said that for children under the age of 27, reimbursements under a health FSA are permissible. You have to remember you cannot reimburse premiums under health FSA. And again, you can only reimburse expenses that were incurred during the period of coverage. So for your plan year for 2016, when the expenses incurred in 2016, that's what you would be reimbursed. Now, we know there are 2 exceptions to that provision. And that's if you permit what's called a grace period, where you have an extended 2.5-month period after the end of the plan year where expenses can still be incurred and paid. Or also if you now have what's called a carryover, where an employee can carry over up to a maximum of $500 into the next plan year. Also under Health FSA, we know that there's a uniform coverage rule. And uniform coverage says that the entire amount of the salary reduction, less any reimbursements that were previously made, always have to be available at all times. Now, I think this is the thorn in most employers' sides when it comes to health FSAs, because we all recognize an employee can, maybe say, I want to take out $2,000 in January. They only contribute $175 to their pay. They go and they have a big bill. They get reimbursed $2,000, and then they leave. Unfortunately, that's the risk of insurance that an employer takes on when it does sponsor a health FSA. So again, under the uniform coverage, that entire salary reduction amount always has to be available. In 2007, another thing that the proposed rules told us is that an employer, if they want to, they can limit eligibility for a health FSA to the employee who only participates in their group health plan. I haven't seen much of that, but that is available out there. Flexible spending accounts, they have non-discrimination rules. Remember, this is a self-insured group health plan, so it can't discriminate in favor of highly compensated employees. Also, previously an employer really had the ability to use the sky as the limit, and employees could salary reduce their pay. However, we know under the Affordable Care Act that it did amend the code such that now employees are limited to what they can salary reduce. And we know for 2015, that maximum amount is $2,550. That's the same amount that was in 2015. The IRS, when it indexed its taxes and permissible limitations this year, it did not edit that FSA amount. What you need to be aware of is this is per employee. So if you have an employee and the employee spouse also works for you, each of those employees would be able to go ahead and salary reduce $2,550. Likewise, if a person has 2 jobs, each employer, they can go ahead and salary reduce the total amount. So other things that we want to talk about, you know, we've had previous conversations in our other webinars that we always want to keep our health FSAs as an accepted benefit. When they are accepted, they do not have to comply with the Affordable Care Act rules, the HIPAA portability rules, and there's also a limited COBRA obligation. Now, as a reminder, to be accepted, an employee contribution cannot be, an employer contribution cannot be more than 2 times the employee election or the employee election plus $500. What employers have to be careful, if you have what's called that flex credit plan, where you're either giving credits or dollars to employees, and they have the ability to put that amount into a health FSA, you got to watch, because if an employee puts too much in, that could throw your FSA out of the exception rule. So be careful with that. And again, we just mentioned a health FSA, it is a group health plan because it provides for medical care, it provides for reimbursement. So it's subject to ERISA if you are a private employer. So just like you have to have the cafeteria plan document, you would also have to have a plan document and SPD that meets ERISA requirements for the health FSA. And since it is self-insured, it can be subject to HIPAA privacy rules. If the FSA would be subject to the privacy rules if you have 50 or more participants on the FSA, or if you have less than 50 participants, you outsource, or the FSA is administered by someone else. So again, some rules that you need to keep in the back of your mind. The next benefit that we want to go ahead and talk about are dependent care programs. Now, the tax requirements for a dependent care benefit, they come under Section 129 of the Code, which incorporates another section, actually it's Section 21. And this provides an exclusion from income for certain employment-related dependent care expenses. Now, this is different than a health FSA in the sense that it's not a group health plan. So it's not subject to ERISA, not subject to COBRA or HIPAA. And also, it is a separate plan. So it can either be incorporated into the cafeteria plan, or you can create a standalone plan. Now, the purpose of a dependent care program is to reimburse expenses for the care of qualifying dependents so that the employee and any spouse can be gainfully employed. And when we're talking about qualifying individuals, generally we do mean a dependent under age 13 who has the same principal place of abode and who that the employer provides for at least 1/2 of their expenses for the year. However, there also can be situations where it may be for a spouse who is physically or mentally handicapped or incapable of self-care. And in some cases, it could also be if you're caring for a elderly parent. If that elderly parent is your dependent, then it also could cover those types of expenses. We just mentioned here that, again, since it's done pre-tax, the IRS always wants to make sure that you're not favoring highly compensated employees So there are some also non-discrimination rules that apply here. Through my years of experience with dependent care programs, I think the biggest question that I've got or that I've received is that employees will want to know, geez, I'm going to be out on disability because I have to have surgery. However, my child's still going to be in daycare. Can I get reimbursed, from my dependent care program while I'm out on disability? And actually the answer is not really. And what the IRS did is, in 2007, when it gave us those proposed rules, it gave a little bit more wiggle room for employees. And it said, if you're out on disability, that you can still have dependent care reimbursements for up to 2 weeks. But after 2 weeks, it's no longer permissible. And why, when you're out on disability, you can't get reimbursed for dependent care is because it's determined that you're not gainfully employed or you're not looking for employment at that time. So how does this all start? Once you've adopted your plan, you've put it in writing, and you do your plan document, then what do you have to do next? Basically, you need to speak to your employees about it, and you have to go ahead and have them elect into the cafeteria plan. So the employee has to tell you what they want to choose. Now, elections can only be prospective, not retrospective. We have actually 2 limited exceptions to that rule. One of the exceptions to this retrospective election is that if an employee, upon being a newly hired employee, is eligible for the benefits as of the day of hire, then that employee can be given 30 days to go ahead and make their election, which that's going to have to go backwards. Also, if an employee gains a new dependent, a new baby, or a new child through adoption, then they can go ahead and make a retrospective election to have that new dependent covered. Also, we talk about elections. They have to be irrevocable during the plan year. Once they're made, they're really in place for a 12-month period, and a plan year, unless you're just starting up a plan, which would have a short plan year, has to be for a 12-month period. Now, we also have exceptions about that the IRS permits certain mid-year changes that have to be specified in the plan document. I want to go ahead and jump back to this retrospective election for just 1 second. A situation that, again, has come across my desk many times is that the employee comes and says to you as the employer, well, I got married 3 weeks ago, and I want to go ahead and add my spouse to the plan. And you look up your group health plan and it says, yep, you can go ahead, you can add your spouse. We'll make the spouse's coverage retroactive back to the first day of the month. What you have to remember is, yes, you can make that coverage retrospectively, but you cannot take pre-tax contributions to pay for that spouse's coverage retrospectively. That can only be done prospectively. So, we're going to talk about mid-year election changes just briefly because we just mentioned it. And these, again, this is the exception to the irrevocability rule. Now, the IRS has put out there 16 permitted reasons why a participant could go ahead and make a mid-year change. First thing I want to clear up is, what do I mean by a mid-year change? I've had employers who say, well, geez, the employee came to me 2 days after the start of the plan and wanted to make a change. So that's not mid-year, so we can make the change. No, the IRS considers mid-year anything that happens after the first day of the plan year. So even if it's only 2 or 3 days into the plan and someone wants to make a change, they have to have an IRS, what's called a mid-year election change reason. Now, as an employer, when you have your cafeteria plan in writing, you don't have to permit all these 16 reasons that the IRS permits. You can go ahead and pick and choose whatever you feel is going to be best for the operation of the plan. However, what the IRS does tell us is that if you are going to permit employees to make changes, that these changes have to be on account of and consistent with the reason for the change. And generally also what the cafeteria plan rules say that the change would really affect eligibility under the underlying benefit plan. So as an example, let's say that we have an employee who comes into you and says, geez, unfortunately my spouse passed away, and so naturally I'm not going to pay for my spouse's benefit anymore, but since my spouse passed away, I want to go ahead and drop the coverage for myself and for my children. Well, we all know that just because a spouse passes away, even though it is unfortunate, that doesn't change that employee's eligibility for the plan. So there's no reason to make a change for the dependents and for the spouse. And another example, and I hear this one a lot, it will be come in and maybe, someone is having marital discord and they want to, they're just really mad at their spouse and they say, I just don't like that person anymore. I want to take them off the plan, so go ahead and drop everything for them. Well, the IRS, if the group health plan says you can drop them mid-year, that's one thing. But really, the IRS, they don't have a reason to say that you don't like a person anymore as a reason to go ahead and make a change. So you have to be very careful in those types of situations. So who can actually participate in a cafeteria plan? Actually, what the rules tell us is that employees can participate and former employees can participate, as long as you don't set up a plan only for former employees. And people will say, well, how do you get a former employee to participate? It generally comes about if you have someone that is, severing from the company and there's a severance program out there. So they may be saying, geez, I'm going to be getting X amount of dollars. I'm going to go ahead and pay for my contributions for my benefits that I know I'm going to get through COBRA on a pre-tax basis. That is permissible. You have to watch, though, because generally that's only permissible through the end of the current plan year. You just, again, need to be careful with that. So who can't participate? Spouses and dependents generally can't participate. Now, before you get all worried and say, oh, geez, I'm always reimbursing expenses from a health FSA for a spouse, yes, they can receive the benefits that are available to an employee. It's just that a spouse can't come in and say, oh, geez, my husband or my wife forgot to enroll in the health FSA this year, and we want to enroll, so here's our enrollment form. That spouse doesn't have any right to enroll, so that's what we mean that they can't participate. Also, we also have to be careful when we're talking about self-employed individuals. We know that self-employed who are considered sole proprietors, they're considered partners in a partnership, and also they're considered more than 2% shareholders in a subchapter S corporation cannot participate in a cafeteria plan. They can't receive the benefits on a pre-tax basis. And then there's another rule out there that we have to talk about, because what the Internal Revenue Code tells us is that there's a rule called the rule of attribution. And the rule of attribution says that I'm attributed to being in the same position as someone else. And generally, it's based because of a family relationship. So as to more than 2% subchapter S shareholders, not only can they not participate in a cafeteria plan, but because of the rules of attribution, their spouse and their dependents, or if their parents, if they're working for that, shareholder, they also cannot participate in the plan. So earlier in the presentation, I talked about saying you have to be careful because you could almost invalidate your plan based on operational failures. So plan document omissions and plan operational failures can cause taxation for all participants. Omissions would be providing for benefits without either establishing a plan or not having all of the other requirements specified in the rules. And if the plan fails to operate in accordance with the written plan or the requirements under 125, then the plan is not a cafeteria plan, and the constructive receipt rules would then apply. So some of the things when we talk about operational failures, again, you maybe are offering benefits not permitted by the rules. You put in that transportation benefit. Participation by ineligible individuals. You're letting subchapter S shareholders do pre-tax. You allow employees to revoke elections or make new elections outside of the rules. That employee who comes in and says, I don't like my spouse anymore, drop the coverage, drop the pre-tax, you go ahead and do that. You don't comply with the use or lose rules. Basically, and we really didn't touch on that too much, but remember, under the dependent care and under the health FSA, any money that the employee does not use at the end of the plan year, except for a grace period or carryover, is lost to them, and it reverts back to the plan. If you reimburse expenses that are not permitted under the FSA, that also would be an operational failure. So what a failure does is, again, it results in taxable income for the participants. And when I have here this no de minimis rule, no de minimis means, oh, geez, it was only a little bit, so that doesn't count. Well, geez, we only let one employee make a change that they shouldn't have made, or we only reimbursed something for $15 that we shouldn't have reimbursed. That's only a little bit. The IRS really doesn't look at only a little bit, so they say a no de minimis rule. Under our cafeteria plans, we have lots of non-discrimination rules, unfortunately. First of all, overall, the cafeteria plan is subject to one set of rules. We have to test to see who's eligible, to see what kind of contribution and benefits were available, whether they were provided to key employees. Now, one nice thing is, if you only have what's called that POP plan, a premium-only plan, you don't have any spending accounts in there, then you can do what's called the safe harbor. And the safe harbor is really, it's almost like an eyeball test. And the eyeball test would be, if you're providing the same benefits for everyone and the same eligibility requirements, then you don't have to do any of the numbers crunching that other plans are required to do. And we do have separate discrimination tests based on the other benefits. So the health FSA has to be tested separately. Dependent care has to be tested separately. Also, if you have health savings accounts, they need to be tested separately. However, the general rule is, again, we're always wanting to make sure that we're not favoring highly compensated employees, that just highly compensated aren't doing pre-taxes and our other employees aren't. The rules say that the testing is required annually. However, I always recommend to employers that you really should test your plan probably mid-year sometime, because in that way, if you see if your plan is skewed, maybe highly compensated or receiving too many benefits, you would have time to go ahead and make adjustments and get your plan back in order. And then finally, what we're addressing today is something called a simple cafeteria plan. And it was recognized through healthcare reform that many employers are not meeting the 125 non-discrimination requirements, and unfortunately, it's especially so for smaller employers. So what the healthcare reform introduced was something called a simple cafeteria plan. And what this rule does, it relaxes the non-discrimination requirements for cafeteria plans as long as a small employer meets contribution and eligibility requirements. First of all, who's a small employer? It's one who during either of the preceding 2 years employed on average 100 or fewer employees during its business days. So it's actually someone that's 100 or less employees. However, and I actually think a simple cafeteria plan, and I'll admit to you, these have now been around for almost 6 years, and I have never seen an employer enact a simple cafeteria plan. And it's generally because of this eligibility and minimum contribution requirement. Eligibility means that any employee who works at least 1,000 hours in a year must be eligible to participate in the cafeteria plan. And the contribution requirement then says that the employer is required, without regard to whether a qualified employee makes contributions or not, the employer has to make a contribution that is at least 2% of the employee's compensation, or 6% of the employee's compensation, or twice the employee's salary reduction. Now, again, depending on what kind of compensation your employees make, that can be really a steep requirement for an employer to meet. So if you do meet those conditions, you can go ahead and have the simple cafeteria plan. And again, if you do, you then don't have to meet all the other testing requirements that other cafeteria plans have to meet. So some short takeaways for today. Let's always remember that cafeteria plans assist employees by pre-taxing premium contributions, that it also saves employers on their FICA taxes. However, the IRS rules have to be followed in order for you to have a valid cafeteria plan and go ahead and escape any type of tax liability. You must have that plan document, and then you have to follow the terms that are in that document. So with that being said, we've come to the end of our presentation. And before we open up the lines for questions, or we look at the questions that you have sent us, I want to go ahead and remind you that our next webinar is Thursday, March 10th. And we're going to be talking about those qualifying events. Remember, I mentioned there are 16 events or mid-year election changes that the IRS permits. And I didn't outline it in today's presentation because in March, that is specifically what we're going to be talking about. So,
the first question, can an employee drop their coverage if they come and say they are going on the plan of the spouse who works for another company?
That's a great question. And the answer is, unfortunately, it depends. What does the term of your cafeteria plan say? And also, we have to look to see what does the term of your group health plan say? Because whenever I talk about cafeteria plans and changes, it really is a dual analysis. You have to see, first of all, if your group health plan permits it, and then the cafeteria plan. I've seen situations where a group health plan will permit the change, but the cafeteria plan doesn't. So the employee is stuck having to pay pre-tax contributions. So that's the first thing I would look at. If your group health plan says that, yes, an employee can drop coverage mid-year, regardless of the reason, we've jumped through the first hoop. Now we have to see, does our cafeteria plan permit it? Under the cafeteria plan, there is a permitted reason that says, due to either an increased benefit that is available, an employee may be able to make a change. So if you've adopted that, that may be one reason to go ahead and make that change. And also, what the IRS permits, and it's, I'm trying to think what words they use, it's to go ahead and prevent this vicious cycle that employees can get in saying, geez, I want to go into my spouse's plan, but their enrollment period is different. So the IRS does say that if a change is made because of someone else's different enrollment period, that the change can be made. Again, your cafeteria plan has to adopt that reason.
Next question. Is it possible to include health insurance opt-out incentives in a cafeteria plan?
That really is a great question, and the answer to that is to provide cash incentive opt-outs for someone waiving your health insurance coverage, the only way that you can offer that is through a cafeteria plan. Because otherwise, if you do give cash opt-outs for waiving health coverage and it's not through the cafeteria plan, you've violated that doctrine of constructive receipt and you've opened up every other employee to taxability. So what you would do to that is you would make sure your cafeteria plan just includes a cash opt-out where the employee can say, I'm waiving the group health plan coverage, and you're providing a dollar incentive for that, and they make that election. Good question.
The next question, can an employee change the HSA deduction on an as-needed basis? For example, I have a large expense, so I need more deducted this week.
Gee, another good question. You're really doing a good job today with the questions. HSAs they're a little bit odd. And what the IRS tells us is that an employer under its cafeteria plan has to permit an employee to make an HSA change. However, that change can be limited to, and it is monthly. So in other words, they can't come in once a week and say, I want to change my HSA contributions. It's basically on a monthly basis, and it is only prospective. So again, if someone sees that they want to put more money in that account, they would need to come in and you would say, okay, you can make the change. It can only be started on your next pay cycle or however you make your contributions to your cafeteria plan. So again, can only be done prospectively. However, they can be permitted to make a change at least once a month.
Do we have any more questions?
Okay, so right now we don't have any other questions. And as we mentioned, I'll go ahead and respond to these questions again in writing, and we'll go ahead and send out to you a copy of the presentation along with the replay and the answers to the questions. And hopefully you enjoyed today. Hope that you found it informational and that you'll participate in next month's webinar on the mid-year election changes, the qualifying events. And also just want to go ahead and note, if you have a specific topic that you would like us to go ahead and address, please let us know. We're always open to suggestions. So thanks so much and hope you have a good day today.